Hi, everyone. This is Rita Garcia from Becoming Awake in the Calm Mom Alliance, and I'm so excited to be doing this with my friend and colleague, Lisa, who is it Crosta? My great friend that I
Correct.
can't remember. Lisa and I are both from New Jersey, and we met in a in-person networking group. It's a wonderful thing if you haven't done in-person networking group in a while. It's very powerful. And she and I were talking about finances and how we both work with a lot of women with different challenges. And one of those challenges is like this money thing. I was just saying to her, people get really weird around money, so people have financial challenges. They don't know what to do with their money. Sometimes you just don't even want to look at what's going on financially. So I wanted Lisa to come, and I also want other financial experts to chime in or come to future events to talk about professional moms and money. And so today is Lisa Crosta, and she has 15 years experience as a certified financial planner and also a certified public accountant. So I wanted this opportunity to have her just answer some general or even more specific questions that you may be having. So we're gonna recording this. So if you're watching this recorded, if you have other questions, either put them in the comments or DM me or DM Lisa. And I'm hoping that if this is something that people like, that we do this periodically with Lisa and other people in the Calm Mom Alliance who have a specialty and knowledge around finances, because I really think this is a way that moms, professional moms, really um, struggle and they really can sabotage themselves around this big question around finances and money. So without further ado, I'm going to, Lisa, please take over and field the questions. And I had everyone, if you have a question, just private message me and I won't say your name unless you want me to, and Lisa will answer your question. So welcome, Lisa.
Thank you. Thank you. So when Rita and I were discussing this, we were talking about if we should have a topic or not. And I thought, well, let's try to keep it really broad. But if we don't have enough questions, I'll just chat. But if anybody does have a topic for future, or you hear people talking about a common topic they have questions on, let Rita or I know, and we'll do something more pointed in the future. Right, Rita?
Yeah, oh yeah, for
Yeah.
sure. Yeah.
So do you see any questions, Rita?
I see some questions coming up in the chat already. So one of the question I this is a question I have too, so it's interesting
Yeah.
that this has come up. Mortgages.
Yeah.
When does it make sense or does it make sense to pay your mortgage early
Yeah.
or to put more money into it every month or to pay it off completely? Like when does that make sense and when is that like not making
Right.
sense?
So if you got a mortgage in the past 10 years, not this year, but maybe the 10 years prior, and you have mortgages in the 2 to 3% range, generally we would say don't pay that off. There's absolutely no rush. That was and is the cheapest money you can get at this point. I mean, lines of credit are higher than that, credit cards are higher than that, student loans are higher than that. Um, I don't know everybody's mortgage rate, but I can tell you if it's in the twos and threes, that's phenomenal. And that interest is deductible. Now, you may not be getting the benefit of that deduction if you don't itemize on your tax return. So, not to go into the weeds, but on your tax return, you either take the standard deduction or you itemize. And some people don't have enough of all those deductions together to get over the standard deduction. So, you may not be getting a benefit from that. But even without that, at 2 and 3%, I personally do not have anybody accelerate paying off those types of mortgages. You can be saving. You can even buy a bond now, a treasury bond, and earn a higher rate of return, 4.5% treasury bills, short-term treasury bills are paying right now, than you are being charged on that interest. And that interest may also be deductible. So with those rates, we are not having people accelerate their payoffs. Now, if you have older, I don't know anybody who has older rates yet because most people refinanced in that giant period of low interest rates. If you have a new loan, you probably don't have the ability to start accelerating that and paying that off. That's not usually what, when people first get a mortgage, if they're getting it now at 6%, that's probably not on the top of their list is to pay it faster. If there's Any good debt, I'd say mortgages is on the top of it. It's an asset that grows generally, especially in our part of the country. I don't know where everybody is. So we do not have people accelerate it. Where you do see some people paying it off more is they're getting ready for retirement. And that's a conversation to have. Like, is there a what is the word? Like, not a financial, but a mental reason why you want it paid off in retirement. Even though you may have enough money to cover that mortgage, you want to have all your payments behind you. And that's an analysis we can do with you. Like, okay, if you do it, where's the money coming from to pay it off? Are you pulling it out of an investment, or is it sitting under a mattress? If it's sitting under the mattress, yeah, you're not going to invest it, pay off that mortgage, and be more relaxed in retirement. So once you get to that stage of your life, it's the balance between the finances and the mental easiness, as I'm trying to think of a better
Mhm.
word, it may give you in retirement to not have that payment. So
And I have a question, a
yeah,
caveat to that,
yeah.
so if you have a mortgage
Hmm.
that you're paying off, is it then easier to well, you could borrow on that, or is it easier for the bank to give you a line of equity? I mean, is it related at all or
No,
not?
I mean the property itself gives you access to a line of credit, not the mortgage. But
I
the
see.
line of credit will be more limited if you already have debt on the mortgage, right? Because they'll limit the
Oh,
most.
okay.
You can only have so much debt. So the property's worth $1 million, and you have a $500,000 mortgage. Some places will lend up to 70%. So you may have another couple 100,000 that you can pull out of that equity in the home. If you have no mortgage, your line of credit will be bigger.
Right.
But
Okay.
line of credits have higher interest rates than mortgages, and they
Okay.
have different deductibility rules too.
All right. Cool. Good to
More
know.
limited.
This is why I'm asking. This is good. Good
Good
info.
question. Good question.
Okay. Anyone else have a question they have? If not, I can go to another question that has just come up. Okay. What is the difference between saving in a Roth IRA or 401k versus a traditional 401k or IRA? So the difference between a Roth
Roth
or a
and
one or traditional.
non-Roth.
Yeah, that always stymies me. I have no idea what the answer
Yeah,
is.
and you see this a lot because they talk about Roth conversion. So let's start in the beginning. So a Roth, whether it's a 401k or an IRA, it's after tax dollars. So you don't get any benefit today from a tax standpoint to saving in a Roth. It grows completely tax deferred. Like, you're not going to have to pay taxes each year on a Roth, but you don't get any reduction in taxes today. In regular 401ks and traditional IRAs, you get a deduction in today's dollars. You save tax money. It grows completely tax deferred. Both of them do. And then where the difference is at the end, because the Roth didn't save you any money now, you don't have to pay any money on it ever. So it grows completely tax deferred, and then it's tax free when you pull the money out. So because I like people, this is how I think it makes people remember it. If you think about the logistics behind it, the IRS you didn't save any money and not pay taxes today. So the IRS is letting you get to it whenever you want and get it tax free. Not whenever you want, but get it tax free eventually. Your 401k, the IRS didn't get some money because you saved money, right? By putting it in there, you lowered your taxable income. So eventually they tell you that you have to start taking it out, and it's fully taxable when you take it out. So it's like they gave you a benefit now, the IRS, right? Oh, I'm going to put 10,000 in my 401k. I don't have to pay taxes on that. Well, eventually, when you're 73, the IRS says, wait, now we want to get taxes on that. And they tell you how much you have to take out. There's required minimum withdrawals on 401ks and IRAs, regular ones, and they will tax it. So the reason I was explaining it that way is sometimes it's easy to remember why. So if you get a tax savings now, the IRS is going to look for you later. You didn't get a tax savings now, they don't care. You can hold it in there, no required distributions, and you don't pay tax on it when you get it out. If it's a Roth, it has the word Roth in front of it.
So you pay now or pay later is basically.
Exactly, yeah. And there's ways to convert traditional 401ks and IRAs into Roth, and they're really great tax eventual tax saving vehicle. But to do it, when you do it, the year that you do the conversion, you pay taxes on everything that's been accumulated in there. So you really have to plan with your tax accountant and with people like me, with planners, to make sure it makes sense. You have the money to pay these taxes. It doesn't affect your other tax situations. You really want to look at it with all your investments together. But we have a lot of clients that do that. They may take a couple years right at the end of retirement and convert these 401ks and IRAs to Roth,
Hmm.
pay the taxes, kind of, swallow that pill over a couple of years, and then they grow completely tax-free going on, and they do not have required minimum distributions, so they can control their tax liability way out in future years. It's not complex. It's just tax heavy. You just have to plan it smart, but it's a really great tool.
Yeah, because I'm thinking if you're growing, if you're putting money in there to save and grow, then when you take it out tax, it's going to be more taxes because it's going to be more money.
Yep. And some people think they're going to be in lower tax brackets when they retire, but we find that doesn't always happen if you've accumulated wealth. And these accounts have gotten large. And since they have required minimum distributions, money you must withdraw, you can't control your tax bracket. The IRS says you got to take it. They're not huge numbers, 4 or 5%, depending how old you are. But, you got $1 million account, you're taking out big money. And if your spouse is too, you may have a higher tax bracket than you thought when you're 80 years old. So
Okay.
it's a little bit of planning to do. Like I said, there's a lot of moving parts, and you don't want to just willy-nilly do it, but it really can be beneficial. And the Roths that go to kids, the other big savings is if you end up with money left at death and you have money in these retirement accounts, when the Roths go to children, there's no taxes associated with it. They still have to take money out, but it's not taxable. When you pass through your 401k or IRA to the kids, they have to take it out over a limited period of time, and they have to pay taxes on it. So
Oh,
some
wow.
people do it just to save their kids tax money. That's the people who really like their kids.
Okay. My kids would be like, ah. Okay. I have a
Some people
question.
don't care.
Another
My kids do
question.
pay taxes.
Another question came. It was, can you talk about taking money out of your business as an LLC? And are you better to have expenses so you're not paying income taxes on your earnings? Does that make sense to you?
Yeah, so an LLC is a thing. The person can clarify this. I'm going to guess from this question that it's a single member LLC and it
Yes,
goes
I
on, right?
believe so.
So a
Yeah.
single member LLC is not an entity. It's a disregarded entity for the IRS purposes. And what that means is like that entity doesn't file its own tax returns and pay corporate taxes. The net from that business flows to your individual tax return. So it's really taxed in one thing, but your expenses, you really want to put them, your business expenses, against your business income, because there's a lot of business expenses that you can't take as an individual, right? On your individual, it's your Schedule A, but you can take it on your business. So run your business properly, have a credit card, keep your expenses, and then the net will flow through to the front, basically, page of your 1040 tax return and be taxed as your regular income. Did that answer the question, Rita?
I think so. It says here also, what is a draw from your business and how is it taxed? Is
Yeah.
that
So think of it as it's really your money. You can move money from your LLC to you, single member LLC. There's no issue. There's no self-dealing. It's all you. It's all taxed the same way. So you can take money from your account. It doesn't affect your profits. It's just pulling assets. It's just pulling income, not income, just pulling assets out of there. So taking a draw or taking a salary, it doesn't make any difference. Same thing.
all right? Good to know.
Yeah.
Good to know. Do you have any more questions, commenter, about this?
Yes, I've stopped my car so I can talk.
Oh,
Hey, Lisa, it's Elizabeth.
Elizabeth?
So I hear all these people like, I don't know, in our entrepreneur, single LLC, exactly like you said,
Yeah.
who are like, oh, you need to pay yourself first and you need to do this and you need to do that. And I struggle with this because, as you know, I pay a hell of a lot of money in healthcare insurance, which
Right.
is an expense, right?
Right. Right.
And a lot of times that kind of is a huge expense, which takes a lot of my income. And they're
Right.
like, oh, but you need to pay yourself. But I'm like, why would I do that? Because then I'm paying taxes on that income. Am I making any
Well,
sense?
there's two things about the self-employment health insurance. So it's a deduction on your little schedule, on your Schedule C, right? Your Schedule C is
Yep.
where you report your LLC earnings, and your health insurance comes off there, and what you pay yourself comes off there. So you're getting to the same net there, but there's an additional deduction for self-employed health insurance that's somewhere else on the tax return, and you want to make sure. I have to think about how that flows through, Elizabeth. You just want to make sure you get that full deduction. And if you end up with a net loss, I'm trying to think if you get it. I don't know that off the top of my head, Elizabeth. We'll have to look at that. but it is basically, it's not like the tax return says, oh, take this first and then take this second. You know, it's all expenses. I almost feel like sometimes people say pay yourself first, just like they say save. Like when you save, you're paying yourself first, just to make sure you give yourself a little income and salary. But it doesn't really affect the net any differently. You know, if you have nothing left at the end of the year and you're paid yourself, your business is in a loss, right? You know what I mean?
So yeah, but it still confuses me in that, okay, so if the whole thing, I pay myself first, so that's coming out as an expense,
Yeah.
or
Yeah.
where is that hitting my Schedule C?
It's right in the beginning. It's like your salary. It's not really salaries, but it's I forget what it's called. I have to look at it. LLC Schedule C to see what it looks like, but it'll be right there. Well, you know what, I have to think about that. You can do it two ways, I believe. I'm gonna look at a Schedule C as I talk to you.
Because it's something that I hear people talk about all the time, and I'm like, why would I do that when I know I have a lot of expenses for my business? And usually my expenses, including my 30K health insurance and this,
Yeah.
that, and the other thing, it's
Right.
wiping out most of my income that I'm
Right.
earning.
And you can't, yes. And actually, no, I'm looking at the LLC, the Schedule C form. So there isn't a line. The net profit is what technically goes to you, right? So the net profit at the end. So I don't understand, and I don't understand, Elizabeth, I agree with you, why anybody would say that, because if your expenses are eating up all your profit, what's the point? Like, I mean, you're still at the, you know what I mean? Like you have a net negative. There's no further benefit from taking a bigger, taking another number. And you're right. Your salary, it's not like you put your salary on an expense line unless you paid somebody else, right? But not yours. Just the
Right.
net profit is yours, and that flows to the front of your 1040. So I don't know what this person's talking about. I wonder if they're not filing as a single member LLC. Could they be filing as a partnership? Is it just one person?
Yeah, one person. I don't know. I've always had this question. I've listened to multiple people talk about this, and I'm like, why would I be doing that? Because then that's then coming in as income on our joint tax return.
No, that doesn't
Right?
make any difference. No, because you don't, again, you are the LLC. You don't pay yourself from the LLC and reduce your income and then add it to your income. Your net is your income. Your net. Like you're one person. So that's, if you were a corporation, that would be different. A corporation would get a deduction for the salary, and then the salary would go to you on your tax return. But that's not how an LLC works, a single member LLC. So you have to send me one of these, Elizabeth. I don't know what they're talking about. I've
Okay.
never, your growth, like on your return, your net profit or loss on your Schedule C is line 31. And that right there, that flows to the front of your return. And that's what you're taxed on. And,
Right.
a lot of businesses, you want to get that low. Now, remember, this is a little weird tax law, but if you have a business 3 years in a row that doesn't make a profit, you're at risk of the IRS telling you it's a hobby. And hobbies don't get any deductions. So you want to really be careful. Like people who just pad their expenses to get losses, you could eventually get caught up. Now, the IRS doesn't seem to catch much these days, but that is a rule. Julie,
So,
go ahead, Elizabeth.
so you're better off having like $1,000
Yes.
in. Okay.
Let's remember too, if you have a profit, you pay into Social Security. And if you want to have any Social Security when you retire, you got to have a profit. That's what your Social Security is based on. So, I know small businesses that are always trying to make themselves not profitable. I'm like, well, do you want to have Social Security when you retire? That's what you pay on the net.
Right. Okay.
Julie,
right.
you had
sure
something.
I have a ton more questions, but I'll think about them and get back to you.
But wait,
Thank
Julie,
you.
I think Julie might have had something to add about the small business stuff.
Well, so that phrase, pay yourself first,
Yeah.
is, and you kind of said this, Lisa,
Yeah.
but as a LLC of one, a solopreneur is what I like to call myself, a solopreneur.
Right.
And yes, I'm an LLC, but that whole phrase of pay yourself first, Elizabeth, I think is a way, is not meant to, this is my take. And Lisa, the money person, can correct me, but it's a way of generalizing that you should take care of yourself in a way, like financially, so that so your health insurance, all of those things, like health insurance, those are expenses for your business. And then whatever, at least, so you think of that as like, you have to pay those things. That's not like, do I pay myself or do I pay my health insurance? Well, no, you pay your health insurance. So that's an expense. Just like, do I have a mortgage? Do I have to pay my electric bill? Do I have to pay for my supplies? All of those are expenses. Put those all into like one bucket in your mind anyway, for your expenses for your business. That's why you have a fabulous person like Lisa, who's telling you how to itemize those and how much, like where to put them and what deductions you can get. But as far as you go as a business owner, those are all things that you have to pay every month. That's that. And then the money that you have left over is your, what's the right word? Revenue, your like, that's your earnings, that's
Your profit.
that's what your profit. There you go. That's your profit. And then that profit you have as a little, that's think of that as paying yourself first. That's your profit, so you don't go out of business.
I also think so. I agree with what Julie's saying, which I kind of said before. It's sort of like a forced savings. If you pay yourself first, right, and every month you in your head you send $1,000. I'm just making this up. $1,000 to your checking account. You paid yourself, and you don't have enough money at the end of the month to pay for that seminar you wanted to go to or pay for that business trip you wanted to do, then you don't do it because you've already paid yourself. You've compensated yourself, and it's in quotes because it doesn't tax any differently, but it helps you control your business expenses because if there's no money left, there's no money left at the end of the month. And it's sort of like a 401k, right? That's paying yourself first. It comes out of your paycheck right away. It goes into there. You can't go get that money if you want to go on a trip at the end of the month. It's in your 401k. So I believe that's what most people are talking about.
Yeah.
And that's financial planning. Taxes really makes no difference whatsoever. So there's like two different parallels going on there. That's what I think. But Elizabeth, send me one of those things. I'll listen to it for you.
All right. Good conversation. Okay, we have like 3 minutes left. Does anyone have one last question they want to ask?
Does anybody have any questions about Social Security? Only because I just did a talk on this.
Yeah.
What about like, I haven't made Social Security in, well, my twins are 21, so I haven't made Social Security anything, haven't contributed for 21 years.
Okay, so first thing you should do, everybody should do this, go to ssa.gov, Social Security Administration, it stands for .gov. If you don't have to write it down, Elizabeth, you can remember it, and log in and find out what your benefits are. And be careful when you're logging in, they ask you those publicly available questions, and if you screw up, you get locked out. So if you get like 2 wrong, log out and come back in 15 minutes because you don't want to get locked out of that. But once you get in, it'll tell you your projected benefits. Now, keep in mind that those are projected and they assume what you made last year is what you continue to make. So Elizabeth, if you're making, $10,000 a year on your business, it's going to make that assumption. So the projections aren't perfect, but it shows you what you've earned so far. Social Security, this is where everybody gets confused, is the average is based on your highest 35 years of earnings. You need 10 years to qualify. So in my example, if you worked for 20 years, they're going to still do a 35-year average. That means they're going to be 15 zeros in that number, right? So the 20 years you worked, the 15 zeros. And again, it's time value of money. It's not the exact straight line, calculation, but they'll do that average. So every year you work that you like, I took years off with my kids. So every year I work, I kick a 0 out of that average. So yeah, you may not have as high a benefit as somebody who worked 35 years straight, but that's what it's based on. You have, as long as you've worked 10 years, you have benefits. Also remember, as a spouse, you have spousal benefits. So each spouse is entitled to their own benefit or 50% of their spouses, whichever is greater. So if your benefit was, I always use a silly example, but my benefit was 1,000, my spouse's is 3,000. Actually, let's flip it around. My benefit's 3,000, my spouse's is 1,000. That spouse is eligible for not just 1,000, but the extra 500 to get theirs to 1,500 because that's 50% of mine. So again, the greater of yours or 50% of your spouse's. So Elizabeth, if you took more time off than Mike did, and you may be getting 50% of his, maybe more than your benefit. So there's something there.
Okay.
And then the benefit's different
helpful.
too. Yeah.
Yeah, I didn't realize that for him.
Yep. And then, when a spouse dies, you get the higher of the two. You get yours or the deceased spouse's, whichever's higher. You step into the higher benefit. You don't get both. Okay. And there's a benefit too if you get divorced, but we won't go there.
And Lisa, when does that start kicking in?
Social
or
Security?
when do you suggest? Yeah.
So the
Is
very
that
earliest,
one you can
the
choose?
earliest you can collect, assuming you're not widowed and don't have minor children, is 62. The latest you collect is 70 because the benefits don't increase after that. So from 62 to 70. If you're born in 1960 or later, which I think is most of us on the call, your full retirement age is 67. And that's when you get no reduction in benefits. So if you take it at 62 and you're eligible fully for 67, it's a 30% reduction. And that may be fine. You got to work this into your plan. Does it make sense? Could you get it 5 years sooner? Or do you take it at 67 or do you take it at 70? So when you're approaching 62 is when you want to, look at these numbers and have somebody do an analysis. And when we look at this all the time, like it may be great to wait, but you may not have the money to wait, or you're healthy. Like if you're not healthy, take it, what's your spouse doing? So you really want to make these decisions, not in a vacuum, looking at all your situation and together if you're a couple. But that's the age, 62 to 70, that's the window.
Great, thank you.
Awesome. So this was amazing. 30 minutes. I don't know about you, but I feel like I learned some things today. Started a controversy around the whole pay yourself first. I love that. A little spice in there. Lisa, how can people find you, or is there a place they can go to get free information about you, or how do they connect with you?
Yeah, you guys can find me on LinkedIn. That's my name right down there. It's probably the easiest. The company I work for is called Crescent Harbor Private Wealth. If you go to the website, you'll see me there. And I've been putting up YouTube videos. There's not that many there, but if you guys want to watch them, I'll get another view. I did one last night on Social Security, and my daughter's editing it for me, so it's not up yet. But we're trying to do more of that. We're reaching out on all the different platforms, but or email me. So my email's long. It's l.crosta@crescentharborpw.com. But you can find me from LinkedIn or the website, and I'll connect. I'm happy to talk to anybody, any questions. Yeah.
Awesome. Thank you so much for coming today. I'm going to stop the recording. Don't go anywhere, anybody.
Okay.
All right. Thanks a lot. Hope you enjoyed the recording.